Just yesterday, on March 11th, 2026, the price of silver suffered an epic bloodbath. A massive bearish candlestick pierced through all technical support levels, slicing through the bull's defense line like a blade. Silver flash crashed, plummeting to 84.46. Retail investors are panicking, forums are howling, and countless leveraged investors were forcefully liquidated via margin calls in their sleep, losing everything. Everyone is asking the same question. With fundamentals remaining incredibly strong and global geopolitics still volatile, why did silver suddenly plunge off a cliff? Is the bull market over? Should we liquidate our positions and run for our lives? If you are feeling panicked right now, if you are preparing to capitulate and sell your physical silver at a loss, please stop immediately and watch this video to the end. Because today, I am not only going to tear away the hypocritical smokescreen put up by mainstream media like Bloomberg and CNBC, but I am also going to hand you a war report straight from the front lines of a financial crisis. This crash has absolutely nothing to do with inflation data. Instead, it is Wall Street desperately covering up the detonation of a $1.8 trillion private credit nuclear bomb. This is not financial advice. This is a survival guide. Fasten your seatbelts. We are about to dive in. Let's first take a look at how, on this bloody night, the mainstream media universally brainwashed retail investors. The anchors on Bloomberg and CNBC told you in extremely professional tones. Silver plunged today because the newly released CPI inflation data came in hotter than expected. This means inflation remains sticky. The Federal Reserve might not cut rates soon. The dollar is strengthening, and the appeal of precious metals has declined. Sounds like a perfect logical loop, right? Sounds completely reasonable? Pure nonsense. This is quite simply the most absurd paradox in financial history. Let's use some common sense. A hotter than expected CPI means inflation is rising, and fiat money is turning into confetti. Gold and silver, since ancient times, have been humanity's ultimate hedge against inflation. The higher the inflation, the more valuable physical money should be, right? Yet the mainstream media is trying to make us believe that because inflation is too high, silver, an inflation hedge, has become worthless. What kind of twisted logic is this? What is the truth? The truth is, silver dropping to $84.46 has absolutely zero to do with inflation data. The CPI data is merely a carefully selected excuse by Wall Street, a smokescreen to cover up their indiscriminate dumping. What they dare not tell you is that yesterday's market saw capitulation selling. When the price broke below key moving averages, algorithmic trading firms aggressively shorted the market like rabid dogs, accelerating the plunge. This is not a reflection of silver's true value. This is a desperate scramble for liquidity. It is a desperate act of raising cash. Why so desperate? Because deep within this market, the foundation of the shadow banking system has completely fractured. If you trace the flow of funds behind last night's dumping, you will discover a spine-chilling truth. Those massive funds that call the shots globally have had their liquidity chains snapped. They are selling silver not because they are bearish on it, but because they need life-saving cash to plug a $1.8 trillion supermassive black hole. Now, let's get to the core of today's video. Turn off Bloomberg and let's see what the real smart money is saying. Just before the crash, Christian Straka, a senior executive at PIMCO, one of the world's largest investment firms managing trillions of dollars, issued a severe warning to insiders. He stated, "The $1.8 trillion private credit market is facing a massive liquidation crisis. What is private credit? And why is it dragging silver down with it?" To help everyone understand, we must break down this highly complex financial term. During the zero interest rate policy, ZIRP era of the past decade or so, money was virtually free. Traditional banks, burdened by regulations, didn't dare lend money to software companies bleeding cash year after year or highly leveraged commercial real estate developers. Thus, private credit funds, a form of shadow banking, emerged. They took capital from pension funds and wealthy family offices, and then lent it at exorbitant interest rates to garbage companies that had absolutely no ability to repay. As long as rates stayed low, everyone was just rolling over debt, playing a game of musical chairs, and the music kept playing. This created a massive, completely opaque $1.8 trillion empire. But friends, today in 2026, the scythe of high interest rates has finally fallen. Those cash-burning SaaS companies, those downtown commercial real estate properties with 40% vacancy rates, they simply cannot generate the cash flow to service these sky-high interest rates. They have defaulted. Simultaneously, the LPs, the investors who entrusted their money to these private credit funds, are panicking, demanding mass redemptions of their capital. And so, the dominoes fall. This is the truth of what happened last night. Margin calls. When these colossal credit funds face a run from their investors, they must instantly come up with tens of billions in cash. But what are the assets they hold? They hold the junk bonds of loss-making companies and unfinished, unsellable real estate. These assets are highly illiquid. In a panicked market, they cannot find buyers at any price. It's like buying a mansion appraised at $100 million, but suddenly you desperately need $1 million in cash to save your life. If you list the mansion today, can you sell it tomorrow? Absolutely not. So what do? You grit your teeth and immediately sell the Rolex on your wrist and the gold and silver bars hidden in your safe at market price, or even at a heavy discount, to raise cash. In the financial world, the logic is exactly the same. When the big players on Wall Street are backed into a corner and desperately need US dollars to fill the gaping holes in their private credit portfolios, they are forced to sell their highest quality, most liquid assets. And in today's financial derivatives market, what boasts the best liquidity and fastest conversion to cash? It's COMEX, the gold and silver futures contracts traded on the commodity exchange, what we commonly call paper gold and paper silver. They dumped the market not because physical silver turned into garbage, but because silver was the only thing they could sell. This is a classic throwing the baby out with the bathwater scenario during a liquidity crisis. It is institutional capitulation to survive, and retail investors became the innocent cannon fodder crushed under the weight of fighting giants. If you think I'm making up stories, it's because you haven't read the history of financial markets. There is nothing new under the sun. Every liquidity crisis in capital markets follows an astonishingly similar script. Let's look at how history rhymes. Let's go back to 2008. Lehman Brothers collapsed, and the subprime mortgage crisis fully erupted. What happened then? At the time, the price of silver was mercilessly smashed from a high of $21 down to a mere $9. A drop of over 50%. What did the media say back then? Economic recession, industrial demand is collapsing, silver is dead. But what was the real underlying cause? Hedge funds lost everything on collateralized debt obligations, CDOs, and subprime mortgages, faced massive margin calls, and were forced to liquidate all profitable long positions, including precious metals. And the result? After they finished dumping, and after the Federal Reserve initiated massive money printing, QE, to bail out the market, silver skyrocketed from $9 to a staggering $50 over the next few years. Let's look at something closer to home, March 2020. The COVID-19 pandemic broke out, and global markets fell into an absolute liquidity freeze due to fear of the unknown. U.S. equities triggered consecutive circuit breakers, and the U.S. dollar index surged. In those short 2 weeks, silver was slaughtered, plummeting to an unbelievable $11. Once again, it was indiscriminate institutional selling in exchange for U.S. dollars. But once the liquidity crisis was resolved, silver surged by nearly 300% in less than half a year. Do you see the pattern, friends? The villain in 2008 was the subprime mortgage crisis. The villain in 2020 was the global economic shutdown. And today, in this March 11th, 11th, 2026 crash, the villain we face is this $1.8 trillion private credit nuclear bomb, incubated in a bed of zero interest rates and loudly detonated in a high-rate environment. This is a textbook liquidity shock. They dumped paper contracts and smashed the price down to a bloody 84.46 SARCs. But this is absolutely not the end. It is merely the final receding of the ocean tide before the tsunami hits. History proves repeatedly, in a systemic crisis, precious metals are always mistakenly slaughtered first, only to rebound in the most violent manner and set new all-time highs. If you've listened up to this point and only think silver has a chance to bounce back, you are only seeing the surface level. The second layer of truth I want to reveal today is an unprecedented spectacle currently taking place in the global market: the Great Decoupling. Pay close attention. While the numbers on the paper market crashed to $84.46 last night, if you went to your local coin shop this morning or visited a major precious metals retail website to buy a physical American silver eagle, could you actually buy it at the spot price of $84.46? Absolutely impossible. The premiums on physical silver coins and bars didn't drop with the spot price. Instead, they are skyrocketing due to panic buying. Mints are running 24/7 and still cannot keep up with the orders, and major retailers are seeing their inventories rapidly wiped out. Why is this happening? Because what Western institutions are dumping isn't real physical silver at all. They are dumping algorithmically generated paper contracts on the exchange. In the current system, for every ounce of real physical silver, there could be hundreds of ounces of paper claims attached to it due to rehypothecation. This game works fine during peacetime, but in times of crisis, it becomes a massive game of musical chairs. What is even more shocking is the immense geopolitical chess game between the East and the West. While Wall Street fund managers are frantically dumping paper contracts to pay down debt, suppressing the price, what are Eastern nations doing? Look at the Shanghai Gold Exchange. Look at the vaults in Singapore. Eastern investors, central banks, and sovereign wealth funds couldn't care less about the paper panic. They are taking advantage of Wall Street's discount prices, using boatloads of cash to drain physical metals back into their own vaults. The West is selling paper to pay off unpayable debts, while the East is accumulating physical to solidify their sovereign credit. Once Western physical inventories are drained at these absurdly low prices, the system will face its final reckoning, a force majeure event. At that point, the exchanges will be forced to announce, "Sorry, we don't have enough physical silver for delivery. We can only cash settle your contracts at these artificially low prices." That will be doomsday for the paper-silver system, and the moment the price of physical silver breaks its chains and blasts off to the moon. As we reach the end of the video, we need to zoom out and examine the macroeconomic environment we are in. This $1.8 trillion private credit crisis is just the beginning. It will not be resolved overnight. In the coming weeks, or even months, as more credit funds freeze redemptions and more hidden defaults are exposed to the light of day, the price of silver is highly likely to experience similar extreme volatility. Volatility will become the new normal. But please remember the macroeconomic backdrop of this very moment. First, the US debt spiral is already a mathematically unsolvable dead end. Interest expenses have surpassed military spending, and the government has no other path forward but limitless money printing. Second, the BRICS nations are accelerating de-dollarization. Not only are they pushing for trade in local currencies, but they are also continuously using gold and silver as the foundational ballast for their new trade settlement systems. Third, global energy prices and geopolitical conflicts are at historic highs. In an era where the old system is collapsing and a new order is being forged, why must you hold physical assets? Because physical silver carries zero counterparty risk. It does not rely on the credit of any commercial bank. It does not rely on the liquidity of any hedge fund. And it certainly does not depend on the empty promises made by politicians. When the private credit market collapses, when digital wealth evaporates in an instant, when the numbers in your bank account are frozen and inaccessible, the physical ounces you hold in your hand will be your only inalienable true wealth. Let me emphasize again, the content of today's video is not ordinary financial advice, but a war report from the financial front lines. The current crash is institutional capitulation for survival at the edge of a cliff. It is the concentrated eruption of systemic fragility. But for smart money who can read the macro landscape, this is absolutely not a reason to panic. Instead, it is the most extraordinary buying opportunity of the year, perhaps even the decade. Because the fundamentals of silver have not deteriorated. On the contrary, they shine even brighter amidst this crisis. Do not be tricked by the lies of the mainstream media into handing over your chips. The ultimate winners will absolutely not be those holding the most fiat digits in the banking system, but those holding the most physical ounces when the old fiat world collapses. Hold on to your physical assets. Buy the dip. Do not let Wall Street's panic rob you of your foundational wealth. If you feel that today's in-depth analysis has uncovered the truth, please be sure to like, subscribe, and hit the notification bell. Share this video with every friend around you who invests in precious metals or still blindly trusts the mainstream media. We are witnessing history, and I believe we are standing on the right side of it. That's it for today's video. Thank you for watching. I'll see you in the next one.